Are you ready to start investing, but you're not really sure where to begin? Or maybe someone else has been managing your money for years and now you want to educate yourself further, which, by the way, is always a smart move because knowledge really is power. Well, in this video, I'm going to walk you through a complete beginner's guide to investing in Canada. By the end, you'll have a solid understanding of the basics from savings versus investing to the different types of investments to the unique Canadian accounts that can make or break your wealth over time. Whether you're saving for the very first time for the first home, or you're planning for retirement, or just getting your money working for you, this guide is your starting point. So let's start with the very basics because without the basics, it's really hard to move forward with confidence. A lot of people try to skip ahead. They start buying complicated investments they don't really understand. But before you do any of that, you need to ask, am I saving or am I investing? Saving is for short term goals. You want your money safe, accessible, and not bouncing up and down with the markets. Think things like a vacation fund, an emergency fund, or a saving for a car. You might need it in a couple of years. Whereas investing is for long term goals. We're talking 5 years or more down the road, retirement, or your child's education, maybe even your grandkids' future. Because investing comes with risk, you need that longer time horizon to ride out the ups and downs. So, here's a simple rule of thumb. If you'll need the money within the next 5 years, save it. If you don't need it for at least 5 years, then investing becomes a really, really good option. Now, once you've decided whether you're saving or you're investing, the next big piece is understanding risk. Risk is basically how much volatility you can handle. If you invested $1,000 today and it dropped to $800 next month, would you lose sleep over it? If the answer is yes, you probably have a lower risk tolerance. If you could shrug it off and wait it out, you might be more comfortable with risk. Risk tolerance isn't about your age alone. It's about your situation, about your goals, and even your personality. This is where diversification comes in. Diversification is also known as not putting all your eggs in one basket. Instead of betting everything on one company or one sector, you spread your money across different investments. That's why if one piece struggles, the others can help balance it out. It's one of the simplest, smartest strategies you can use as an investor. Now, let's talk about the building blocks, the main types of investments you'll come across in Canada. So, I'll talk about number one, which is stocks. When you buy a stock, you're literally buying ownership in a company. If that company grows, your share in the growth is also growing. Of course, if the company struggles, so does your investment. And that is the information about stocks. Now, let me talk about bonds. That's another type of investment. Think of bonds as lending money to a company or the government. They promise to pay you back with interest at a set date in the future. It is generally much, much more safer than stocks, but the returns are comparatively lower. Now, let me talk to you about GICs, Guaranteed Investment Certificates. These are very low risk. You park your money for a set period of time, and the bank guarantees to give it back plus some interest. Great for short term goals, not so much for long term growth. So remember that. Great for short term goals, but not good for long term growth. Now, number four, mutual funds and ETFs. You've heard these words many times. These are the baskets of investments. Instead of buying one stock or one bond, you buy into a fund that holds dozens or even hundreds of those. ETFs usually have lower fees, while mutual funds are often actively managed. Number five, private investments. These include things like private lending or private equity. They're more advanced. They're less liquid and usually for experienced or higher net worth investors. Each type has its role, but most beginners start with a mix of stocks, bonds, and funds. Now, let's talk about something that is uniquely Canadian. And this is one of the most important parts of investing here. We have different types of investment accounts. And these accounts don't just hold your money, they actually determine how your investments are taxed. Have you heard the word tax? Do you like it? And let me tell you, choosing the right account can make or break your wealth over the long run. So let's walk through the main ones. Number one, the TFSA, the tax free savings account. Now, don't let the name fool you. Yes, it says saving, but in reality, it's one of the most powerful investing tools we have in Canada. With the TFSA, you can hold things like stocks, ETFs, GICs, and more. And the magic is that any growth inside the account is completely tax free when you withdraw the money. That means whether your investments double, triple, or more, you don't owe a penny in tax on those gains. By 2025, if you were 18 back in 2009, where the program started, you'll have a total of $102,000 in contribution room. And if you've not been using it yet, the good news is that the room carries forward. So you can catch up. This is usually the first account I recommend people look at. This is the best thing we Canadians have. After that comes the RRSP, the Registered Retirement Savings Plan. This one works a little differently. Think of it as a tax deferred account. Every dollar you contribute reduces your taxable income today. If you make $70,000 a year and you put $10,000 into your RRSP, the government taxes you as if you only made $60,000 that year. Your money then grows tax-free inside that account, and you'll only pay tax later on when you withdraw in retirement, ideally when you are in a lower tax bracket. That's why the RRSP can be such a powerful tool for long-term wealth building. Now, what about a non-registered account? This is just your standard plain investment account. You don't get special tax breaks like with a TFSA or RSP, but it's completely flexible. You can invest as much as you want, wherever you want. And for people who've already maxed out on their TFSA and RSP, this is often where the extra money flows. So just keep in mind, any growth in here is taxable each year. So you'll want to be mindful about the type of investments you want to hold in this account. Now, first, home savings account. This one is relatively new and it's a game changer for anyone saving for their first home. The FHSA combines the best of the TFSA and the RRSPs. So the mixture of two. When you put money in, you get a fast deduction just like the RRSP. And when you take it out to buy their first home, it's tax-free, just like the TFSA. That's a double benefit. You can contribute up to $8,000 per year with a lifetime maximum of $40,000. And for anyone planning to buy a home in the future, this is one account you don't want to miss. Another really important account is RESP, Registered Education Savings Plan. This one is designed to help parents, grandparents, or really anyone saving for a child's education. The beautiful thing here is that the government matches part of your contributions through grants. For example, if you put in $2,500 in a year, the government will give you 20% of that, which is $500. That's a guaranteed 20% return on your money right from the start. And if you are a lower income family, you could qualify for even more. So if you have kids or even grandkids, the RESP is a must consider. Now, finally, the RDSP, which is Registered Disability Savings Plan. This is for Canadians who qualify for the disability tax credit or who are caring for someone who does. The RDSP is incredibly powerful because it comes with significant government grants and bonds to help build long-term financial security. It's one of those accounts that doesn't get talked about enough. Not very many people know about it, but if you qualify, you absolutely want to look into it. So, there you have it. Those are the big six Canadian accounts: TFSA, RRSP, non registered, FHSA, RESP, and RDSP. Each one plays a different role, and the real power comes from using the right account at the right time. That's how you build wealth efficiently here in Canada. Start with your goals. Are you saving for retirement? Are you saving for your home? Are you saving for the education? Once you know the goal, match it to the right account and investment type. Keep it simple at first, automate your contributions if you can, and build consistency. Over time, consistency beats trying to time the market. You might be wondering, should I do this myself or work with an advisor? The truth is, it depends. Do it yourself investing can save you fees, give you control, but it also requires time, knowledge, and discipline. Working with a professional can give you guidance and structure, but make sure they're not just pushing their own product. Ask questions, compare fees, and find the right fit for you. Before we wrap up, I want to share three really common mistakes I see Canadians make when it comes to investing. And if you can avoid these, you'll be ahead of the most people. Mistake number one: chasing hot investments. You know how it goes. You are at a barbecue and a buddy is bragging about this stock, a particular stock that just shot up 30%. The temptation is to jump in. But here's the truth: if everyone is talking about it, it's usually too late. By the time it hits the news or the family gathering, the big gains have already happened. Stick to your plan instead of chasing fads. That's mistake number one. Let me take you to mistake number two, which is overreacting to market dips. Markets go up and down. Anything that goes up comes down and again goes up and comes down. This is market. And this is very normal. Yet, so many people panic when their portfolio drops and they sell at the bottom. That's one of the fastest ways to lose money. Remember, investing is about the long game. If you are in it for the long term, short term drops are just part of the journey. And mistake number three, which is a very important one: ignoring tax planning. This one doesn't sound exciting, but it's very crucial. Where you hold your investments, whether it is in a TFSA, RSP, or a taxable account, it can be just as important as what you are actually investing. A good tax strategy can save you tens of thousands of dollars over your lifetime. So, if you can avoid those three mistakes: chasing hot tips, panicking during downturns, and ignoring tax strategy, you'll already be way ahead of most beginner investors. So here's the bottom line: investing in Canada doesn't have to be overwhelming. If you start with the basics, savings versus investing, knowing your risk tolerance, understanding the main investment types, and using the right Canadian accounts, you'll already be on the right track. Remember, investing isn't about luck, it's about having a structure, sticking to your plan, and letting time work in your favor. If you found this helpful, keep exploring. Check out more of our videos on tax strategies. I've got a lot of videos on retirement planning and building long term wealth. And if you're ready to take your planning further, don't hesitate to reach out for guidance. Thanks for watching, and here is to building your financial future one smart decision at a time.